Now, in the beginning, when we looked at the comparison between the current and revised GRAP 104, taking note, the new standard is highly focused on judgment. That means with presentation and disclosure, the purpose of disclosure is to inform users of the following. What is the magnitude of the financial instruments for the entity? What financial instruments exist? How are they measured? And what types of risks exist because of these financial instruments? The risks need to be quantified. And how are these risks managed through identification and mitigation? This needs to be considered carefully when we are disclosing information now versus in the past, where we typically disclosed certain types of risks driven by a template that was used or a list from the standard. The following should also be considered when disclosing information in the financial statements. Only disclosures that are relevant to the entity. It cannot be a checklist of what to disclose in the standard, and here there is no checklist. Only material information should be disclosed. The information that an entity discloses for financial instruments need to be specific to that entity. We have looked at a few areas where there are rebuttable presumptions that an entity needs to decide on an accounting policy that needs to be developed, and certain assumptions that need to be made. Best practice is not to duplicate disclosures, but to cross-reference between notes so that it is not cluttering what we disclose in our financial statements. Credit risk is the area for disclosure that has been the most significantly impacted. So I have included an example of what would be disclosed in the financial statements. The source is listed at the bottom of the slide. For credit risk management, in terms of an illustration of what we expect to see in the financial statements, is our instruments considered to have a low risk? What would be seen as low and high risk? The definition of what is seen as default for a particular entity and why they have defined those number of days in this case, namely more than 90 days past due as the definition of default. The write-off of a financial asset is, for example, when there is no reasonable expectation of recovery of financial asset in its entirety or a portion thereof. Disclose the determination of what customer is individually significant and the grouping of the collective assessment. This all needs to be disclosed specifically for an entity. The disclosures that we are talking about apply to the following instruments: recognized financial instruments because they are within the scope of GRAP 104. This is, for example, cash and cash equivalents, trade receivables and payables, loan receivable and payable. Unrecognized financial instruments because those are outside the recognition and measurement scope of GRAP 104, but the disclosure requirements apply. Finance lease payable recognized by a lessee, lease receivable recognized by a lessor, financial instruments within IFRS 4, loan commitments and financial guarantee contracts. Certain rules and certain disclosures have not changed. Offsetting, there is no change. We cannot offset unless certain requirements have been met. The carrying amount of each category of financial instrument needs to be disclosed, being financial instruments at cost, concessionary loan information, and default and breach information related to loans payable. As indicated, there are big changes in terms of credit risk presentation and disclosure. Financial assets past due or impaired disclosures were removed. The scope of disclosure looks at credit risk disclosures that apply to all instruments to which impairment requirements apply. The two exceptions relate to modifications, and we will look at it under the disclosure requirement later in the slides. The objective is to show what effect credit risk has on future cash flows and the amount, timing, and uncertainty of those cash flows. Credit risk management practices need to be disclosed and how they link to the expected credit loss. We spoke about, for example, the significant increase in credit risk grouping default and the write-off policy. It is very important to remember that judgment plays an important role in how forward-looking information is incorporated. That means an entity needs to disclose the methods of how it was determined, the assumptions that they made, and the data that they have used. How is the credit loss measured? Is there a significant increase in credit loss? Is an instrument credit impaired? This is quite significant disclosures that need to be included in the financial statements. A significant number of additional disclosures that need to be made, such as amounts that arise from ECL. We need to disclose and explain the changes in the loss allowance and the reasons for it. Per class of instrument, a reconciliation between the opening and closing balance and the movement for the 12-month ECL, the credit impaired financial asset and financial risks, and if the credit risk has significantly increased. Furthermore, show how the changes in the gross carrying amount contributed to the changes in loss allowance. This is an illustration of where we explain changes in the loss allowance. In the reconciliation, we will disclose movements in the impairment allowance for trade receivables. I have just made an additional note so that there isn't confusion. The receivable written off is not a write-off. It is amounts that were written off that were included in the impairment. Remember, we said we need to also disclose the changes in the carrying amount and the changes in the gross carrying amount that contributed to the changes in the loss allowance. Once again, I have included an illustration of the following significant changes in the gross carrying amount of trade receivables that contributed to the changes in the impairment loss allowance. In this case, it had to do with the growth in business in different countries, as well as an increase in credit impaired balances and a decrease in trade receivables due to the packaging segment of this particular entity. Take note of the disclosure of quantitative and qualitative information required. Let us continue with the required presentation and disclosure of credit risk. Further amounts that need to be disclosed that relate to credit risk impacting the ECL are whether there are modifications that didn't result in a derecognition. Remember to scope exclusions for disclosures. This is where they are applicable. If the loss allowance was measured at lifetime ECL, if the loss allowance has changed from lifetime to 12-month ECL, sub-bullet 1 is applied to lease receivables and receivables where the modification took place when they were more than 30 days past due. Sub-bullet 2 is not applicable to lease receivables. This can be in the case where there's potentially a change in the payment terms for a debtor. The disclosure required when considering the impact of collateral on the ECL include disclosing the maximum exposure to credit risk without taking collateral into account, quantitative information about collateral held as security for credit impaired financial asset, description and nature of collateral. Explain the significant changes in the quality of the collateral and information about instruments the entity did not recognize loss allowance because of the collateral. For credit risk presentation and disclosure, we also need to disclose the risk exposure. We need to show where the risk is concentrated, the exposure to the credit risk by looking at our risk rating credit risk rating grades, and it needs to be separated between 12 months ECL, purchased or originated credit impaired financial assets, those for which credit risk has significantly increased, those that are credit impaired at reporting date, and receivable or lease receivables that follow the simplified approach. I have included an illustration which is an extract for you to see what the risk exposure disclosure would look like. In this case, the disclosure provides information about the exposure to credit risk for trade receivables and contract assets from individual customers between the periods that it's due, the weighted average loss rate, the gross carrying amount, loss allowance, and credit impaired consideration. The disclosure needs to be a type of risk group to know what the risk group is. An entity needs to determine as part of its accounting policy what the risk groups would be. A maturity analysis needs to be disclosed for the remaining contractual undiscounted cash flow. Also, how liquidity risk is managed, for example, committed borrowings or other lines of credit available to access cash. Lastly, we will look at market risk. In the current GRAP 104, sensitivity analysis is a choice. In GRAP 104 Revised, sensitivity analysis is once again compulsory and needs to be disclosed for each market risk, the risk changes that are considered reasonably possible, and what would the impact or effect be on surplus and deficit. Take a moment and consider the following. The presentation and disclosure in the revised GRAP 104 is heavily impacted by judgment that needs to be included. An entity must prepare for the revised standard, work through classification as a start, then initial measurement and subsequent management. Think about what should be disclosed in the process for the different types of financial instruments. The required disclosure for GRAP 104 Revised cannot be left until the very end.